We are back talking about the rate cap repeal. For your benefit, His Excellency President Uhuru Kenyatta has rejected the 2019 finance bill. He has reverted this back to Parliament, directing them to remove the rate cap repeal, the law on the rate cap repeal, and then allow for the finance bill to go ahead. A lot of excitement on the Nairobi Securities Exchange. Banking stocks already up 5%. Equity Bank highest mover for the day, 40.97 million shares traded. This is over 10 times the daily trading average that we see on this particular counter. Question is, we're already up 5%. How much further can we go up? We have had 15 to 25%, but in the short term, can this be sustained? We are in studio joined by Mr. MUGENDI, who's the Assistant Head of Investments at CYTONN. Now, Kale, before we took the break, I think I like the way you just demystified the opportunity here. And yes, you do see that there could be a reversion to the mean, which means about 15% to 25% price appreciation, but possibly not for very long. Now, before we look at whether this is going to continue for the medium to the long term, I want us to look at the fundamentals of the banking sector. You're saying we're in a robust environment. Let's look at the revenue generation for the sector vis-a-vis the expenses for the sector. Now, I know you have published a very good and insightful report, and you have looked at the net interest margin. That is the cost of debt vis-a-vis the revenue that the debt brings in. And this is at 6.1%. How has it come to 6.1%? How could it actually go going forward based on the rate cap?
Yes, basically because of the interest rate cap and the decline in yields of government securities, because there's a lot of liquidity in the market last year, the net interest margin actually came much lower from the 8% to around 6%.
Okay.
And this is basically just measures what you are able to earn in terms of interest income from your interest earning assets, being mainly for bankers' loans and government securities. So with a repeal of the interest rate cap, then the banks will not have to operate or loan out at the capped interest rate.
Okay.
So they have that possibility or ability to price for risk higher than allowable right now under the cap. So this will actually lead to an increase in interest income, which will also lead to an increase in the margins that they're getting. So
do you see a scenario where we move from 6.1% with regards to the net interest margin to about 8%?
Yes, that
in
should
what
be,
duration?
That should be the case. Actually, even within close to 1 year, we should see that 2% increment. If the rate cap is repealed before the end of the year, then the whole of 2020 will have that reversion, upwards adjustment to around 8%.
Okay, that's interesting. And then what happens in terms of the repricing? Because I've spoken to a couple of treasury departments, some of the local banks, and what we've had is this new rate, if the removal of the rate cap could possibly apply to new loans, would that be the case in your estimation, in the conversations that you've had over the day, or is that expectation that this new rate cap will actually apply to the existing loan portfolio in Kenya as well as any other loans that are out there?
My expectation is that it shall apply to all loans.
All loans.
But doesn't necessarily mean that if you have a facility at the bank, let's say running at 14 or 13% right now, that you'll automatically be repriced upwards. It's basically the ability to reprice your given risk. So based on also because of the banking sector charter, the engagements with clients has become more personal, and there's better integration between banks and relationship management.
So the banking sector charter, but what is this? Is this a new engagement between the Central Bank of Kenya and the banks in Nairobi or in Kenya?
Basically, it's a charter that outlines the guidelines of how to engage in the banking activities in the country, how to engage with clients, disclosing of fees, how their loans operate, and things like that.
So what you're saying is, based on this, there won't be an immediate repricing of the existing loan portfolio, but certainly an immediate repricing of any new loans, and then a gradual repricing of the existing portfolio.
Yes.
So the banks all ascribe to to the banking sector charter?
Yes, dependent on the Kenya Bankers Association,
Yes.
which basically includes all the banks, in Kenya. So
Okay.
they've also prescribed to the charter,
All right.
which will actually bring more discipline, stability.
More discipline and stability. So in other words, through the Kenya Bankers Association and the intervention by the central bank, the banking sector has actually become slightly more disciplined. So they won't, you wouldn't have the element of an obese child now going back to his or her bad habits.
Yes.
On a light touch. But that's a very interesting element, because now I come back to the question where you're saying you do expect a correction with regards to the revenue generation by the banking sector. And the key parameter that we are looking at here is net interest margins.
Yeah.
So from the last numbers that we have seen reported, this is 6%. You think it goes to 8%. But I mean, I want to throw a spanner in the works. How do you go to 8% if you're also in a way being controlled by the banking sector charter with regards to how you treat your existing loan portfolio? How quickly can we ramp up this revenue generation?
Well, as you know, what happened immediately, the interest rate cap came into place. Most of the banks actually preferred lending to the government directly in terms of the risk, risk reward and risk-based profile of the government is much better than your client. So what I do expect is most of the funds, or a huge portion of the interest earning assets being government securities, to now be directed towards either
so
new
you
lending.
expect a reallocation from government securities and into the private sector. That's very interesting, because I think the last statistic that we have seen is the growth with regards to government lending was about 14.2%, and growth with regards to private sector lending was 6.4%. So does that mean that we should expect double-digit growth with regards to loans given to the private sector?
Well, I do expect a ramp up. It has been increasing slightly this year from the lows of around 3-4%. Also because of the various partnerships and programs that have been started in terms of lending directly to SMEs, to certain sectors of the economy through partnership by banks, and these initiatives that have been spurred during the interest rate cap regime. But now going forward, I do expect some reallocation, more lending towards private sector, because a lot of banks that we've also been in engagement with talks with, they say that one of the issues is that they don't want, it's not like they don't want to lend, but it's a pricing element of risk that they can't price within
that they are unable to price the risk. Okay, fine. So revenue is certainly, they expect a huge uplift just because of the rate cap repeal.
Yeah.
What about the element of cost, looking at operational cost as well as loan loss provisions? Because you have said that the banks have become nimbler. They're operating on a lower operational expense compared to where they were at 3 years ago.
Yeah.
That's certainly commendable. Is there an element of risk with regards to one particular line? That's loan loss provisions. In other words, if loans become more expensive, be fair and people out there, will they be able to repay this loan?
Well, I wouldn't necessarily just look at it from the interest rate point of view, because during this period of capped interest rates, we've actually seen non-performing loans in the sector shoot up. It's now around 10.3% average for the sector. Even before, historical average was around 7 to 8%.
All right.
So banks have tried also to move forward towards more collateral-based lending, looking at engaging with clients better in terms of how to deal even with the loans before they become non-performing. And then there's also the issue of IFRS 9 on the expected credit loss model. So there's a lot of factors in play. I still think that banks will keep on lending, but still not just lend to, because you can price anyone that they lend to anyone. There'll still be the background checks on the credit reference bureau, so just to see if the client that you want to give a facility with can be able to repay based on their cash flows and incomes. Yeah.
All right. Now let's go back to what is happening on the stock exchange today. 5% up KCB, 5% up equity. Largest trade we've seen is Equity Bank, and that's 40.97 million shares traded. Cooperative Bank is also up 5%. Barclays has been flat. Now, when you look at these two banks, Equity, KCB, top tier 1 banks,
Yeah.
a proper, a strong capital base.
Yep.
For them, they can, especially equity, which has been lending to the government, they can quickly ramp up the capital allocation to the government and just move this to lending, private sector lending, and quickly benefit from this upsurge. Conversely, when you look at the likes of Cooperative Bank as well as Barclays Bank, the attraction before today was the dividend yield. So 8%, 10%, whatever it was for the respective banks. So now, how do I look at it? How I want to put money. You've told me I could do 50 to 25% in the short term. There's the opportunity of revenue increasing. Where am I putting my money if now I'm looking at the banks?
Well, I can't give you any specific, but actually the thing is Barclays Bank has been ramping up its lending. All right. And I do expect that to reflect in the interest income.
So is that your best pick for the banking stocks? I mean, I have to get away with the best pick, your top 3 banking stocks at this point, because I know yesterday when we were confirming this engagement, the scenario must have been different. We have now the rate cap. So we're operating on, rate cap has happened, we're operating on expect access to credit in the environment. Okay, fine, there will be the element of non-performing loans, but because of IFRS 9, that risk affiliated with that is not as we would have expected it to be 2 or 3 years ago. So that's a strong sector. But then the upside for this sector has changed. I want you to tell me your 3 picks. I won't hold you to it, but you must be able to tell me from your own models, from your own numbers, from your own engagements, top 3 picks.
I will go with again the top tier KCB, equity, and before today I will have given you something like I&M. Yes. Due to the ramping up of the non-funded income growth. Yes. I still expect that to play out. So I can also go with that.
Okay. So I&M is going to be, it's going to be there. Okay, fine, perfect. I like the asset allocate. I mean your topics with regards to the banking sector. So it's just a matter of looking to see. This is my second last question. We have seen a lot of excitement today. When the rate cap repeal actually happened, there was a bit of concern and the banks went down. I remember some of KCB and equity went down all the way to 26. But then within a day or two, there was a quick, everybody's like, okay, fine, it's not as bad. I mean, we can get through this. Yeah. So is this a scenario today where everybody's very excited? Oh my goodness, this has happened. We didn't expect it to happen. Just get me in. Let's figure it out. In other words, are we going to see this rally sustain in December? Would we be seeing KCB at 43, equity at 37, and I mean Cooperative Bank as well at about 12 and a half? Or will we just go back like, okay, good to know, going back down?
I do not expect a knee-jerk, this to be just a knee-jerk reaction.
It's not a knee-jerk reaction.
I think the rally can be sustained. You see, basically, if you look at markets, we do have more knee-jerk reactions when everyone wants to get out. Yes. So when the selling is happening, then we do see a huge decline and then possibly a recovery after. But this upside today is also based on fundamentals. If there's not a huge, we do not hear a lot of resistance from parliamentarians, lawmakers, that no, will still reject and force through the 2/3 majority. Then, if everything goes well after these next 2 weeks, and after the session, Parliament comes back into session, and if they're able to actually repeal the act, we expect a slow grind higher moving forward.
So what you're saying, in other words, this 2 weeks, it's you decide what part of the bet, what side of the table you're on. Is it heads, is it tails? And you go with it. Kwenda na kufa na kupona. Because it's like, what you're saying is, if you wait for the 2-week mark, which is 1st of November, you can't go and buy or sell based on a decision that has been made. But then you have a 2-week window to decide how do you think this conversation is going to go and to position for it. Yes. Would you be buying in the next 2 weeks as we come to the end of the show?
I'm still a buyer. I do think even without their interest rate cap, we were still a buyer. Okay. And we expect earnings growth to, as I said, is a positive surprise.
All right. Yeah. Perfect. Anything else that you're excited or concerned about with this rate cap repeal, or any other initial thoughts that we might not have covered?
Well, as I said previously, we have been proponents of an amendment or a repeal for the longest time. I think Parliament, if they do want to push through the interest rate cap. Possibly we might see the corridor being introduced. There was something like that we had earlier in the year. Of,
what do you mean by a corridor?
A corridor of for the risky clients, okay. Possibly a corridor above the cap. If it's 4% of above the central bank rate, then possibly another cap of 6% for 6% above the for risky clients.
Is this contained in the banking charter,
no,
or
no,
is
no,
it
no.
a separate conversation?
It was a separate conversation. It was trying to get some traction in
okay.
In Parliament. I do expect that to be somehow of a saving grace if the parliamentarians decide to force through the 2/3 majority.
If they haven't already made a decision this afternoon, because last week there was the order paper, but then the order paper changed in the afternoon. So it's certainly worth looking out to see what the parliamentarians are discussing.
Yeah.
Thank you very much, Caleb, for your views.
Right.
There you have it, ladies and gentlemen. Mr. Caleb Mugendi, who is this unassisted head of investments at CYTONN. His responsibility allocating capital, looking at the investment case for the banking sector, engaging with the CSIT with regards to understanding the banking strategy and where to place money, so that when he tells you that KCB Equity and INM are his top picks, you certainly must pay attention. When he tells you this sector is already up 5%, but there's another 15 to 25% left on the table, if you're not paying attention and you lose some money, then that has nothing to do with us here. We have given you the information. We still want you to engage with us. Are you a buyer? Are you skeptical of what the government is happening? Is this sustainable? That is on the one side if you're an investor. Conversely, if you are a user of this debt, how will you be able to withstand the element of a higher cost of credit on your part? And are there ways for you to actually reevaluate your personal net worth, maybe even sell some assets to be able to contain the extent of the impact with regards to your cash inflows and your cash outflows? We really certainly want to hear your thoughts on the day. We are running live on our Metropole page. Engage with us on Twitter. See you once again tomorrow at 2:30. Good afternoon.